Okay.
Welcome back to the show. We are joined today, a special occasion, by the legendary Professor Steve Keen. For those of you that have followed along with the show, we've had Steve on. I think this is the third time's a charm. Steve, thanks so much for giving us your time. Before we get into the show, I just, to show support and thank Steve, obviously, for his time here. So Steve, you're actually participating or in the process of a candidate in the Senate there in Australia. So we'll put a link to that so you can go vote for Steve Keen to basically disrupt politics here. We've also got Steve's latest book. I don't actually have a copy on me, but I do have a copy. The Steve Keen, The New Economics, a manifesto. So we're going to give away 5 copies of those. So anyone that's interested, anyone that wants a book, honestly, just comment in this comments below. I'll just pick 5 people and we'll get those books shipped out to you. And then, of course, last but not least, I am a subscriber to Steve's Patreon page, where basically Steve puts out unbelievable information. People always ask me, Steve, do you have a background in economics? And I say, no, I don't. I just read a lot of Steve Keen. So, this is a great learning experience. And basically what I wanted to open up this conversation was, last time we had Steve on the show, it was really a discussion that was during the onsets, the depths of the pandemic. We were wondering, how we were going to get out of this unscathed. And to really Steve's credit, which governments, I guess, maybe listened, they expanded their balance sheets. The government's expanded massive balance sheet. I don't know if you want to call it helicopter money, but, we sort of papered over the worst of what could have been a financial crisis. And now we're at this interesting inflection point, which I want to get Steve, your comments on, is everyone now is talking about raising rates. We've got inflation. We had a big spending party during the pandemic, and we're just going to normalize interest rate policy. We're going to bring, the Fed funds or the Bank of Canada's overnight rate, or, you're in Australia, the RBA's rate to 2%, 3%, 4%, 5%. It seems like there's no limit, no ceiling on how high central banks can go to fight inflation. But it seems like everybody has forgotten about the role of debt, and particularly private debt. So how are you looking at this? Can you just kind of give us your current outlook right now?
Yeah, we're all focused on government debt. This is the neoclassical obsession with government debt, which is provably wrong-headed, because they say, oh, you're borrowing from the future. The government borrows from the public to spend and all this debt. And if the government borrows, it drives up the price of money, blah, blah, blah. It's all garbage. It's all about as an accurate vision of how the economy operates as Tommy's vision was of how the solar system operates, Earth-centric. The sun orbits the Earth and stuff like that, or that baloney. They had a right to not know it was baloney to some extent 500 years ago. But economists have been shown that they're wrong, and they're still coming out with the same damn baloney. So they're obsessed about the level of government debt. I have to get that down. Well, they've ignored the huge level of private debt, as you say, and they don't realize that also that private debt is not, Steve lends to Steve, and one Steve can spend less and the other Steve can spend more. So it's like a seesaw, you say the same average height, no matter who's up or who's down. But in the real world, banks create money when they lend. And if you then have them debt levels falling, then you're destroying money. And nobody borrows for the sheer pleasure of being in debt. So that they then borrow to spend. So when debt's going up, you've got an increase in aggregate demand. And when you have a fall in aggregate demand, you've got a fall in debt, you've got a fall in aggregate demand. So they're not factoring that into their thinking at all. And of course, as you and I both know, the level of private debt is huge in certainly most Anglo-Saxon countries. And when they start putting rates up, if they do, and they will, I think, reverse the direction of private debt from rising to falling, you'll get negative credit, and that's going to cause a much more severe downturn than they expect.
Yeah, no, it's really well said. I think just to maybe summarize, and correct me if I'm wrong here, but basically the idea is that, okay, when people see effectively interest rates going up, right? people are almost being discouraged to basically go take on money, right? Like central bankers are tightening financial conditions, by raising rates. I think they're basically telling people, listen, like we need to sort of slow demand. So don't go and borrow money, right? I just look at it always from the housing mechanism, which is like, people right now that are prospective home buyers, they're looking at mortgage rates going from, 1.5% to now they're at 4%. And they're saying, you know what, I'm going to wait. And so we see all these people that are now delaying purchasing, and through that mechanism, this basically means new mortgages are not being created, which means that new credit is not being created, which is, in credit, as you just said, is aggregate demand. Did I get that right?
Yeah, I mean, this is something which I've had this fight for 20 years about what's the role of credit in aggregate demand. And the funny thing is, it's something which the non-orthodox mob got wrong as well for a long, long time, and only a few people like myself and Michael Hudson in particular, Richard Werner as well, realized the role of credit in aggregate demand. And it takes a long time to work these things out logically, and once you've done it, it's obvious. Okay? So that's actually in my new book, The New Economics, the manifesto. I prove that credit is part of aggregate demand and aggregate income. And that's all because banks lend money and create money when they lend it. So the vision that neoclassicals have, this loanable funds nonsense, that they presume Fred lends to Lisa is their vision of what banks actually do, their intermediaries. And if that were true, then credit is not part of aggregate demand. But banks create debt and create money at the same time. And in that situation, credit is part of aggregate demand and aggregate income. And of course, it turns up not just in consumer markets, but also asset markets. So if you start having negative credit, you're going to hit house prices. And there two things happen. First of all, people are no longer willing to buy the houses because they're being sucked in by rising house prices. So that tends to be an amplifying feedback. It pushes you further down the same direction. And secondly, central banks are reverse direction, because they've nailed their torsos to the mast of asset markets before and after the Great Recession, particularly after with QE, and they'll dive in and try to rescue the markets when it starts to fall. So I don't think interest rates are going to go anywhere near as high as banks expect, because the bang that they get from putting rates up a bit is going to be much more than they expect.
Yeah, no, I'd love to actually pick your brain on that, because it's funny. I mean, as you talked about, it's, I always just look at, the Canadian data here which is, residential mortgage credit growth is currently running, or was running just most recently, at a 14-year high. Yeah. And so it's, very surprising that, ding, 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 that, national home prices increased or inflated at their record pace over the past 12 months. So national home prices in Canada are up 26%. We've never seen that pace of home price appreciation ever, or at least in modern history here over the last 30 plus years. So, surprising that mortgage credit growth, that people are borrowing money to inflate the house prices. And that's obviously created, as you talked about, the aggregate demand, which is, hey, your house just went up $300,000 over the last year. Now you can go on vacation, buy a boat, and maybe even buy a second rental property. And so, central bankers are now basically beholden to that, trying to sort of drain the liquidity. I mean, what is your opinion of, like, what is it going to take for central banks to sort of, I guess, pop this bubble, or how far do you think they can get, really? Because I mean, I think I don't know what the forecasts are depending on the central bank, but I mean, it seems like everybody's saying that, a 3% overnight rate is basically a lock at this point.
I don't think they're going to get that far, because again, it's like people think they're putting a light touch on the accelerator, but they don't realize there's an amplifier under the accelerator, and that's what's going to go wrong, because central bankers are still predominantly slaves to neoclassical thinking, even though they record the data, and the Bank of International Settlements as an exception there, by the way, but not actually involved in lending, of course. They collect the data, but they ignore it, because according to their theory, the level of private debt doesn't matter. If you remember the fight I had with Krugman when he saw my back in 2012, I think it was.
What was he? Secular stagnation?
No, that's Larry Summers. Let's put our morons in the right box. But But Krugman said, why does it matter? If I stash, and he actually this basically mailed out loanable funds. If I put more money in a bank, which lends it out to somebody else, that doesn't necessarily mean a fall in aggregate demand. That's their thinking. And he's right. If that's what happens, then it wouldn't. But that's not what happens. The bank creates a loan, and that creates money, and then the borrower spends that money on buying a house or buying goods and services. So that change in money becomes one for one part of aggregate demand. Now, if you suddenly turn that from positive to negative, then that's an amplifier they're not even expecting to be hitting. So a couple of small rate rises, if they turn credit growth negative, will have far more impact on demand than they expect, because they're not even looking at that component. And we can come to the screen share, but I've done a little comparison of house prices and household debt across Australia, America, and Canada. And you can see exactly the effect you're talking about, this huge boost to credit, which is causing a change in, positive up to the GDP and asset prices as well. But if they turn that negative, which with maybe even like a 1% rise in rates, if that turns negative, then down goes the demand in the economy.
Well, yeah, I mean, I think we're already seeing that. I don't know. I think this has been historically the quickest pace of financial tightening, or at least in the bond market anyways, over the last, we had, like I said, I mean, it's not just Canada, but it's the US in particular, and all parts of the world. But, in Canada, we've had mortgage rates go from 2% to 4% in like 6 weeks. I mean, it's unbelievable.
Boy, that's going to be fun. That's going to be fun.
And I can tell you anecdotally is that we've seen just a drastic reduction in house purchasing activity. We're seeing, now, again, I know the market was extremely frothy, but like we're seeing, and this is not an exaggeration, we had like a blow off top in the housing market here in about February. And that was particularly driven in the suburban markets, the COVID trend where everybody moves away from the city to buy a bigger house. And so if you look at any house in a particular neighborhood in the suburbs that was selling in February, the neighbor that is selling the exact same house today is taking, on average, I would say about a 15% discount compared to what his neighbor was getting in February. Now, again, I know that February was this blow off top. People were paying too much, but we are seeing a significant shift. And keep in mind, as we've talked about, yes, the bond market's moved most of this, but I mean, the central banks have only been able to move the overnight rate by 75 basis points. And apparently we got another 225 basis points to go this year. So I could question for you is, the sort of the common rebuttal that I get when I try to push back on, the central bank's ability to really normalize policy. People always say, this is our Paul Volcker moment. This is the 1980s. Don't you remember the 80s? We're going to raise rates to whatever percent that we need to kill inflation. And so my question to you is, again, maybe you can elaborate on debt to GDP levels today compared to the 80s, but also as a central banker, do you actually have any ability to fight inflation when the debt metrics are as bad as they are today?
Nothing like what you had back in the 1980s. I mean, if you go back to the 1980s and looking at the data right now, I'll bring it up in a sec. Household debt in Canada was under 50% of GDP. Now it's over 110% of GDP and falling at the moment. So two and a bit times the debt level. So your interest rate rises have at least twice the impact that they had beforehand. And one other thing which we haven't mentioned, but it does also apply. Again, their model says Steve lends to Steve, and it's then only if Steve borrower has a higher marginal propensity to spend than Steve saver, do you get an increase in aggregate demand out of their model? And that's again something Krugman threw at me in our argument back in 2012. But in the real world, the people who are doing the borrowing, people like you and me, people pay the money to banks, and the financial sector's rate of turnover of money is much lower than the real economy. And of course, most of that turnover is buying other financial assets. So if you have an increase in the interest rate, you're transferring income from the non-financial sector to the financial sector. It'll turn over more slowly, and it won't buy as many goods and services. So you have a double whammy on demand that way, and they're not braced for it at all. So to me, they will be dampening demand more than they expect, but it won't have the impact upon inflation because, as I'm saying, I'm writing now for the Epoch Times, by the way. I've got a series of columns that you may have seen, and one of called "It's Not Your Daddy's Inflation." So what we've got now is really fundamentally a supply chain inflation after a huge boost to aggregate demand from a very necessary increase in government deficits. But this is basically the falling apart of an artificially low cost structure given to us by globalization and just-in-time manufacturing. And you can't fight that with interest rate rises. So the price is going to continue rising even as the central banks try to reduce inflation using higher interest rates.
Yeah, that's actually a really good point. So basically what you're saying is that, I mean, probably similar. I don't know if you read how much of the work that you've read of, Dr. Lacey Hunt, but, too much debt, the velocity of money is falling precipitously because it's basically just going into unproductive financial assets, as you mentioned. And then you've got a situation where we have this because of this pandemic and all these global macro shifts, as you have this, the changing of global supply chains. Places like the US, for example, re-onshoring manufacturing. So it's basically what you're saying is that you perceive that we're going to have structurally higher inflation just because a lot of that deglobalization. And so it doesn't matter what central banks do. You don't really perceive it so much as a demand side issue as more of a supply chain issue. And not just a supply chain of like, hey, China's locked down, so we can't get our ships out, but more so that the fracturing of supply chains permanently because of this sort of repatriation, I don't know what you would really call it, but re-onshoring of manufacturing.
Yeah, we've gone from offshoring to onshoring. And of course, it takes time for that to happen. It should happen. I think I was opposed to the level of globalization that occurred for a whole lot of reasons, not the least of it, because they based it on the argument for free trade, but they actually translate, as Dean Baker says in a very recent column, free trade is another way of saying let's screw the working class. And what you get is, you get lower costs because you're paying lower wages, and then there's more profit to the capitalists, and you increase the inequality in society. And that was the basis of it. So my most recent column in Epoch Times, I recount being in China in '81. This is run a conference between Australian and Chinese journalists. But as part of it, we did a tour of China. And most of what we saw, I thought was going to fail. We got to the Shenzhen Free Trade Zone and we saw what was happening there. And what they were doing was saying, we're going to attract American capital, but there are conditions. And the condition was that any American firm had to have a Chinese partner. And within 5 years, that partner had to own half the business. Now, that gives you an idea of the scale of the cut in wage costs that was attracting them in the first place, because American capitalists don't give away half their profit unless there's an enormous gain for them somewhere else in the system. So the huge increase in profits, which ends up also being shared with the Chinese capitalists. That's where all the major Chinese firms came from, and screw the working class in America, and therefore you have this really lousy income outcome for the workers. But hey, look, you're getting cheaper goods for it. Well, now we're at the far end, and the goods can't be that cheap anymore because both of the supply chain disruptions through COVID, but also what's coming away in terms of climate change. And you unwind that cost structure, you're going to see inflation no matter what. So it's immiserization of the working class, as Marx once put it, on rather more of a global scale than he was considering.
And yeah, right. And so you've got this, not only that, this the supply chains re-onshoring basically, but with that and this sort of the end of the deglobalization is probably more power back to the working man or working person or whatever, that will benefit them in higher wages as well, which is also more inflationary.
It's happening to some extent in America, not so much in Australia, definitely. So inflation's well above wage rises, and forget about onshoring manufacturing. There's barely anything to onshore back to in Australia. A bit more in Canada and America, obviously. But I think you've destroyed the power of the working class to bargain for higher wages. by crushing the union movement over the last 40 years. So, and the gig economy structure isn't set up at all to encourage, wage demands. I think you'll get it for a while, but then as soon as the economy tanks again, you'll go in the opposite direction. And to me, the real problem is that we are going to start seeing ecological elements of this. We're already, COVID, in my opinion, is an ecological crisis, not just a medical one, because we're pressing on the tiny remainder of the world that's not hasn't been subjugated by humans, and therefore viruses don't care whether we, they don't read Milton Friedman or Ayn Rand, and suddenly they've got a new territory to move into, and we're now running out of essential minerals, which if we've got to stop using fossil fuels. All this stuff is going to undermine long-term profitability and all the demand that goes with it. So I can see just living standards falling, and rapidly, even though you've now, at the moment, you've got a labor shortage in America. If you take that demand out of the way by putting interest rates up, you're not going to reduce the inflation, which is caused by that fall in the supply chain. So, if they continue pushing something that doesn't work, then, putting interest rates up, trying to reduce demand and reduce inflation, they do reduce demand, but don't reduce inflation, then we end up in a slump.
And so now let's say, I think you have a pretty good idea of how these people think. How do you see them realistically playing out? Do you think they keep pushing and going, gosh, it's almost like them, doing zero rates and QE for a decade and saying, well, we can't generate inflation, and they keep trying the same thing. So yeah, does it work in reverse, where it's like, we can't get inflation down, darn, we gotta keep going despite the obvious demand destruction that they do in the process? Do they double down on that? What's the logical central banker playbook here?
I think they'll double down until they start seeing asset prices fall on a large scale. So like if you're talking about a 25% fall in prices in Canada, in house prices, if they start seeing that in the negative equity, they'll go in the reverse direction. Well, they're then be caught in a dilemma that the only tool they think they have to control inflation is the interest rate. And that causes asset prices to crash far faster than it causes consumer prices, which continue rising. And so they get caught in a dilemma. Well, do we want falling asset prices? And when they're looking at the balance sheets of the banks, because the main responsibility the central banks have actually is to maintain the solvency of the private banking sector. If they can see that falling over, then they'll go into reverse and start dropping rates, even though they've got high inflation. So I can't see them ever getting it to anywhere near interest rates, anywhere near the rate of inflation. And that's going to stimulate them, because they say, well, what do we do? Because according to their theories, if the interest rate is well below the inflation rate, then they're stimulating the economy. And yet they're saying, well, it's booming too much, we've got to pull it back. So I can see them finally having the existential crisis they should have had back in 2008.
Yeah, maybe walk us through that. I know you've got some models there, and I've read your books in the past, and one of my favorite ones. It's, again, free plug here for everyone to go check it out. I mean, it's simple. What is it? I don't know, 100 pages. Can we avoid a financial crisis? And it's really just a very quick, easy read, and it just basically highlights the level of private debt, and it really highlights Canada, Australia. I think New Zealand's in there. Yeah. It's really just these countries with really high levels of private debt, and no coincidence, high house prices. So I don't know if you have any quick models that you're looking at and saying, okay, well, this is something we're flagging here.
I'll actually just share my screen now. Wait for it to turn up there. But what I'm showing here is Canada, Australia, and the USA, and the red line is the level of household debt. You can see it's going off the scale in Australia's case. And very different pattern to America. And in Canada and Australia, you've got rising house prices all the way through, including through the financial crisis back here, a little bit of a drop, but on they went, and then America, we all know, boom, drop, and now it's rising once more. And if you look at those three charts, you're likely to say, well, there's no pattern, no consistent pattern. The charts down below are exactly the same data analyzed. And what I've done is I've taken the change in household debt, and the change in house prices. And what you can see is that the ups and downs of those two are exactly the same, even though the the aggregate performance looks so different, because what drives rising house prices is rising levels of new mortgage debt. And you can see, again, you're talking about the increase in credit demand in Canada and the increase in house prices. That's the blue line shows house prices have gone from changing by about -2% per year back in 2020 to plus 10% per year in 2021-22. That's where the 26% rise, because of compounding over 2 years you're talking about there. And it's been driven by this gigantic spike in the change in new mortgages. And that's the pattern you can see in each of these countries. That's what's happened after COVID. COVID's pretty much 2020, which is this grey line. All three have had that effect. Now, if you then start putting up interest rates, when you start driving the rate of growth of private debt down unintentionally or intentionally, but not realizing what the impact's going to be on aggregate demand, you're going to drive those negative as well. So that's what I expect, an impact on asset markets much more severe than they expect it to be. And then what's their response? Well, fundamentally, they can't control the actual, the nominal rate of inflation, the rate of inflation of consumer goods using interest rates, but they can control what happens in asset markets. So I think they'll panic about what they're doing to asset markets in reverse direction.
Yeah, no, that's fantastic. So one of the common rebuttals that I get, and I'd love to hear your comments with this, I'm not going to say too much, but one of the comments I always get is, well, how much house prices have gone up, particularly in the last month. What would be such a big problem if house prices, let's say nationally just dropped 20%? If they just dropped 20%, we're only going back to the prices that we saw 6 or 7 months ago. Not a big deal, right?
Yeah.
Can you explain?
What's happened is the equity position of the owners is plunged. And it's always a notional equity. This is what pisses me off about people focusing upon house prices and say, this is the value of your assets. You've got to liquidate a house before you've actually got money in your hand. So it takes time to do that. And of course, a lot of people won't do it, but they look at it and see, I've gone from positive to negative equity. Not what I like. So it has far more impact than people think it's going to. And again, the main thing it comes back to is that change in debt is part of aggregate demand. So you go from positive credit to negative credit, and then the economy slumps. And that particular variable is not in mainstream economic models. So the volatility is far higher than they expect, and they can't explain it. What they do is they whack up their stochastic term, and they attribute it to random change or going in the same direction, which is hilarious. Now, if you have it all going in the negative direction, then you get far more of a slump than you expect. And that's the thing. That's why I say it's an amplifier. And that's what's been left out of people's minds when they say that. It's true. You get back to the same, prices as a year ago, but you have a dramatic fall in demand as part of it, and that's not what people are expecting. That's what people are not expecting to happen. That does happen.
Right, and the knock-on effect is as you mentioned, it's less consumer demand or aggregate demand, which feeds through to people, maybe not going out for restaurant for food that night. So then the waitress makes less money, and vice versa. You see a drop off in housing starts, which then people get laid off because there's no need for that construction worker. So it seems like central bankers have kind of blown and inflated this thing to such a level that they are, as you mentioned, beholden to markets.
Exactly. Particularly asset markets. Yeah.
And I was going to ask you, what about the position of the commercial banks? I know that, I know that what you talk about, which is commercial banks have the ability to create money at the flick of a keyboard. But, if their equity position is impaired by 20%, how does the commercial bank navigate?
It's not so much the commercial banks aren't quite so dangerous there, because of course they have limitations on what they can lend to. So it's actually the non-bank financial sector that tends to be where this fun occurs. If you ever read Paulson's On the Brink, Hank Paulson?
No, I haven't. No, I didn't read that one. No.
Okay. You can actually, if you just find the back cover, you can read it without paying him any money, because the key punchline there, I think it's reproduced on the dust jacket. And what happened was he Morgan Stanley? I forget which particular vampire squid he belonged to before he became.
Yeah, I know. Yeah, I think was it not Goldman? I don't know.
Maybe in Goldman's. Yeah. So he got a call from his successor at Goldman's, and the successor said, Actually, this is actually in the book. It's not on the back cover, but but anyway, he got a call when he was Secretary of Treasury, and he said, look, you got to do something. If you don't do something soon, we're going to go bankrupt. And he said, how long have you got? And the answer was about 3 hours. Now, the thing is, when you've got a share portfolio as part of your backing, then share prices, as you know, can plunge in an instant. House prices don't fall as fast. So banks don't have that. They've got loans, et cetera, et cetera. But it's what happens to the where are those loans in the, paying their interest and paying the principal required, or in the distressed asset bucket. When they get put across to distressed assets, that's when the banks have trouble. So you will get most of your drama is going to occur in the non-bank financial sector. So things like your superannuation funds, pension funds, 401ks, whatever you have in Canada equivalent to that, where they've got a share portfolio and where they've got property as well, then they are required to have positive equity. So they can very rapidly approach a negative equity situation, and then all hell breaks loose. And then the central banks have to run in and try to rescue that. So that's the main part they're beholden to. Commercial banks, you will see them having more impaired assets. That's what's going to worry the bank, and that the regulator will worry about that. We have a divided situation in Australia. There's a regulator that's piss weak, that's different to the central bank, which is equally piss weak, but piss weak in other issues. So they'll go into panic mode, I think, when this all starts happening. But it won't be as drastic as if you're looking at the non-bank financial sector.
Yeah. So what is the mood over there in Australia? Because I was reading an article, I don't know, a day or two ago. And, keep in mind, I'm far away here, but I'm reading an article and it's telling me that the opposition party in Australia is proposing to buy up to 40% of a home. And I'm going, this is utter insanity. I know that they're an opposition party, but the fact that thought is even floating out there, to me, seemed obscene. I don't know what's the sentiment right now in Australia. And I don't know if you have any comments on that.
We're utterly sick of the leader. The person we've got running the country is Donald Trump minus the hair and the charisma. Okay. Scott Morrison. He's on the nose with everybody. He was an accidental prime minister because we had a whole lot of internal party shafting at the leader going on between both parties for all. It was so ridiculous at one point that a comedian that I know offered a crowdfunding system to pay for a telephone time system, which would tell you every 10 seconds who the prime minister was. Okay, it was that bad. And just after he put that crowdfunding out there, then the Liberal Party elected this guy by accident, because there were two other guys vying for it, and they both fell over and this guy shot through. But he's loathed, okay? So most of the focus is on getting rid of him. But the Labor Party, which is almost certain to be the government, came up with a scheme of they'll buy 40% of the cost of the property. So if it's $1 million property, which is a bargain in Australia these days, you've got to only raise 600,000 to buy it. The government puts in the other 400,000, and then your deposit needs to be 2% of the 600,000. So I'd say rush into the market, kids. And then part of it also, the government's funding formula is based on them making a profit, which means, of course, they want house prices to continue rising. So they're trying to achieve the holy grail of expensive, affordable housing. That's what they're doing.
Yeah.
Okay.
I mean, they're doing that in Canada too. They are coming out with, there's more of these shared equity programs. So the government,
same thing. Yeah.
Government will take 5 to 10%, I believe 5 to 10%. I mean, this doesn't have much uptake right now, but they'll take 5 to 10%. They'll help you with the deposit basically, and they'll take an equity stake in your home. So it seems like Australia is doing or proposing the same thing, but at a much larger scale. And it seems to me that governments around the world are, I always make the joke, which is everybody wants affordable housing, but nobody wants their house to become affordable. And
exactly, that's right.
And so it's kind of like, well, how do we kind of keep this almost Ponzi going? And, we can't lower house prices because that would be very painful. But so why don't we just start helping people buy their homes for them? And that way we can maintain the values of the asset.
And what you've got is government money creation being used to maintain a Ponzi scheme. Yeah.
Right.
So that's exactly what's happening down here, and even worse, as you say, than Canada. So I've said, look, just if you understand that rising levels of new mortgage that cause rising house prices, that's your trap. You've got to get out of it, but you've got to get out of it in a way that you don't wipe out your household sector, because if you do actually let the market, rip, as Austrians will argue for, then you're going to have a plunge. You're going to go to a crisis and people wiped out. That happened in America, of course, and you had a very, very deep recession, the greatest since the Great Depression. So they're trying to avoid that. And as part of it, they've got to keep on pumping asset prices up. So you get this ridiculous situation where the government's got to come in and back you. So government money creation power, it should be there to provide infrastructure, education, all health and welfare, ends up going into supply house prices. It's insane.
Yeah.
And so I've come up with a proposal of a way to reverse it while maintaining the equity of homeowners. Now, it won't do so much good for landlords, okay, but it'd help out homeowners, and it would definitely help renters. And so, because as you look at the data, the proportion of the population that's being forced to rent now is rising. It's virtually doubled in the last 25 years. And it's getting to the point where the renters are going to be the majority of the population. And they think, screw you and your high house prices. We want somewhere we can afford to buy at some point if we want to become owners, and they're all the young. So this disenfranchisement, I think, is making a real political issue, and that's what I think is going to be the breaking point in this whole cycle, rather than any sensible policy by economists or politicians.
Yeah, no, I'd love to kind of hear your proposal there, because people always go, I float this idea around, like what you've talked about, which is a debt jubilee, and maybe that's not politically palpable this time, but I mean, it seems to me it's inevitable, which is just math, which is too much debt. You can't keep growing the debt because it's an unsustainable burden, but you have to keep growing the debt in order to maintain the asset values and stave off a Great Depression 2.0. So now we have governments basically buying people's houses now. And so what is the solution, or like what is a realistic, or not even, it doesn't have to be realistic, but like how do you get out of this trap? Like what is
well, look, I'll share my screen because I want to show what's been happening in terms of household tenure in Australia. So the red line is the percentage of the population that owns his house outright. Numbers don't sum to 100%, by the way, because this is a census and some people aren't home, and there's people at home on the day that get counted. But it was 43% owned their own houses in 1989. Now it's down below 30% in 2018. It's about to be even lower now. And then the blue line is those who have mortgages, gone up from 30% to 37% there. It's probably approaching 40% now. Those renting has gone from 18% to 27%, probably 30% now. So if you add up the percentage of the population that either owns their own homes outright or is renting, you get 70% of the population. And or the ones that are either renting or in mortgage debt getting higher and higher, and the owners going lower and lower. The political shift is going in favour of people who rent, can't get into the market, or people who are crippled by the level of debt they've taken on to be in the market. So I think the possibility for a political change that says we're going to reduce the level of household debt and do it in a way that favours renters, and that's what my proposal does. So you use the state's capacity to create money to give everybody an identical amount of money. And if they're in debt, they must pay the debt down. If not, they get a monetary injection, either in form of cash or you make it in terms of bonds, because you'd issue bonds to back the creation of money that goes on when the government does something like that. And normally those bonds reside with the banks, but you could then say, well, if you don't have any debt, like if we gave you $100,000 and you had zero debt, you'd be required to buy $100,000 worth of bonds from the banking sector, which were government bonds financing this monetary reset, but they own 3%. We could put rates up again. You actually could get high interest rates again out of this. And what you then get is, well, renters get a benefit. Normally, any policy about housing ignores renters. Okay, well, it's trying to benefit people trying to move from being a renter to being an owner, but of course they go from being a renter to being a mortgagee. Okay, so they go from paying the landlord to paying the bank, and so the finance sector takes over. I want to reverse that, but also make it possible for those renters to use the equity we create for them as a way of actually buying house prices, which you're bringing down. Okay, we've got to stop this nonsense of pushing house prices up all the time. Now, the weakness of that, of course, is if you bring house prices down without bringing household debt down, then you push homeowners into negative equity. So this scheme would say we're going to reduce house prices, but reduce debt as well. So on the house owner front, not the homeowner, okay, not house owner. You get the distinction, okay?
Yeah.
Homeowners will see their debt levels fall, their equity will remain constant, and then their proportional equity actually rises because it's going to take them less time to pay it off. So you benefit everybody, except those who are landlords on a grand scale. Now, of course, that's where your politics comes from. It's the landed, it's the rentier class, not the renters. The rentiers are going to complain. And they're the ones who still dominate how government thinks. And like in Australia's case, I think this, on average, each politician owns about 3 homes. So they're okay to that when they leave in on this scheme. They're not going to do so well out of the 2 that they're renting out and trying to make capital gains on. So we've got to break that mentality. And politically, that was just impossible. If I go back to the 1990s, just weren't enough people who were renting. The 1/5 of the population. Now it's coming up to 1/3. So the longer this goes on, and remember, all these policies were designed to improve home ownership, and they've done the exact opposite. So it's the political shift is finally coming in that direction, and was sheer happenstance, I'm riding that wave.
Yeah, no, there's another vote for Professor Steve Keen right there, because I think that it's funny, as in Canada we have the same thing. There was a list out, showing all the politicians that own multiple homes, and so that's why I'm always skeptical to think that as much as that might be the right thing for society, which is what you proposed. I always say the skeptic in me says that they're going to try to keep the system going, but then we run into a process where nobody owns homes, everyone's kind of a serf basically, and is paying to the rentier basically. It seems to me like the monetary system essentially is broken.
Yeah, and it does, and I think it's been the exact opposite of what we should have been doing. We should have been using money to create productive resources, money to move us away from fossil-based fuels to renewables and nuclear, improving the education standard of the population rather than dumbing it down to QAnon levels. So this is all going to come to crunch, I think, mainly through climate change, because when that hits, particularly resource exporting countries like Australia and Canada, they're going to find they can't export those resources anymore. What happens to their balance of trade? And then that happens to economic prosperity out of that. If I think you're better off with the manufacturing sector than Australia is. But suddenly, you've got to manufacture your stuff domestically, and you've got to expand your industrial base. Where can you turn your real estate agents into engineers? I don't think so. So all this sort of stuff is just going to stimulate us at a time when we need productive engineers, not financial engineers. We haven't got them. We've run that side of the society down. All we've got to show is high house prices. So when that particular shit hits the fan, I've got a feeling, even if we haven't got political dominance by the renters as opposed to the rentiers, then the rentier world's going to fall apart.
Yeah, no, I mean, it definitely feels like at the end of the day, something has to give. But, I want to be respectful of your time. And I think you've brought, you always bring together all the macro. And I think the one thing that I've always come to appreciate with a lot of your work is the ability to disseminate the information. Because I think that so many economists, even the ones that actually do understand the system, there's very few of them, but they lack the ability to explain it to the typical person. And so again, I'd highly encourage everybody to go check out Professor Steve Keen's work on his Patreon page. He's got so many good books. And again, we just comment below and we'll give away some of his most recent book there. And Steve, thanks again. Good luck in the upcoming elections. Go vote for Professor Steve Keen, and let's change the monetary system here.
Thank you, Steve. A nice wrap.